All right, everyone, get ready for a deep dive today into William Bernstein's The Four Pillars of Investing.
Yeah.
You want the key insights, right?
Wrong.
Without having to read through like hundreds of pages.
Exactly, yeah.
We gotcha.
This book.
This book is great because it tells you not just, the what of investing, but the why, which, let's be honest, is where I think a lot of us trip up.
Yeah, I think that's right.
He lays it all out in four parts: theory, history, psychology, and the business of investing.
One thing I really appreciated about this book is how Bernstein weaves together these seemingly separate ideas to create a holistic approach. He shows us that investing isn't just about numbers, it's about understanding, human nature and market dynamics, and even the inner workings of the financial industry itself.
Okay, let's start with that first pillar then, investment theory. What's the foundation?
Well, the cornerstone really is the relationship between risk and return.
Mm-hmm.
This is fundamental. If you want the potential for higher returns, you have to accept more risk.
Right.
No way around it. But Bernstein, he gets insightful here. He uses this great example of obscure mortgage bonds during the Great Depression.
Oh, wow.
These investors, they weren't tracking the daily price drops. They didn't really care about the short-term noise, and they ended up doing really well because they just held on.
Oh, that's interesting because it almost feels counterintuitive. Like, I know I'm not supposed to be checking my retirement account balance every day, but, sometimes
Right.
it's hard to resist. So if we're not supposed to fixate on these daily ups and downs, how do we approach investing strategically?
Well, Bernstein argues that one of the simplest but most powerful strategies is owning the entire market through indexing.
Mm-hmm.
So instead of picking individual winners, you buy a fund that tracks a broad market index, like the S&P 500.
Yeah, okay. But doesn't that mean we're just settling for average returns? Like, part of me still wants to believe I can beat the market.
I get it. That's a really common misconception. Bernstein really digs into this idea of market efficiency. Information spreads so rapidly that it's incredibly difficult even for the pros, to consistently outperform the market. Think about it this way. Even massive pension funds that have teams of analysts struggle to beat the market consistently.
So are you saying we should all just buy an S&P 500 index fund and call it a day?
I mean, that's a really good starting point.
Yeah.
But the S&P 500 is just one piece of the puzzle. Bernstein actually emphasizes diversifying across different asset classes. You've got your large cap stocks in the S&P 500, but you also want to think about adding things like small cap stocks, value stocks, even international stocks, real estate investment trusts, or REITs.
So each of those is a different, part of the market. Why is that so important?
Think of it like this. Each asset class has its own personality, its own risk and return profile.
Okay.
Some are more volatile, some are more stable.
Right.
Spreading your investments across those categories creates a smoother ride. When one's down, another might be up.
Yeah, okay. So it's all about, building a safety net.
Yeah, exactly.
Gotcha. Okay. So diversification is like building a safety net for our investments. I'm starting to see how all these pieces fit together. But what about learning from the past? Doesn't history have something to teach us about investing?
Absolutely. That's where Bernstein's second pillar comes in, investment history.
Yeah.
He takes us on this wild tour of bubbles and manias, from the South Sea bubble way back in the 1700s all the way to the dot-com frenzy of the late 90s.
Yeah.
And it's fascinating to see how human behavior plays out again and again.
So it's not just about avoiding specific historical events, but understanding the patterns of human behavior that lead to these boom and bust cycles.
Exactly. Take the example of the Nifty 50 in the 1970s. These were supposed to be blue chip growth stocks that everyone piled into, convinced they would just go up forever. But the bubble burst. Many people lost a fortune.
Oh, wow. So what's the takeaway there?
Don't get caught up in the hype. Bernstein shows us that chasing the hottest trend is rarely, if ever, a winning strategy. You need to understand that markets move in cycles, and those cycles are driven by fear and greed.
So it's about recognizing that those emotional forces are always at play and not letting them control our investment decisions?
Exactly. History might not repeat exactly, but as Mark Twain said, it often rhymes.
Okay, that makes sense. But I think there's another piece to the puzzle here, and that's our own psychology, right? We're not always rational, especially when it comes to money.
You hit the nail on the head. That's Bernstein's third pillar, investment psychology. This is where he dives into the world of behavioral finance, exploring all the ways our brains can sabotage our financial well-being.
Yeah, and I'm sure I've made my fair share of those psychological mistakes
Oh, yeah.
over the years.
Yeah.
What are some of those like common traps that we all fall into?
Well, there's overconfidence, thinking we know more than we do.
Mm-mm.
There's herd mentality,
Right.
blindly following the crowd. But one of the big ones is something Bernstein calls myopic loss aversion.
Myopic loss aversion. That sounds scary. What exactly is that?
So it's this tendency to fixate on short-term losses,
Okay.
even if they are a part of a larger long-term strategy. It's why people panic and sell their investments at the worst possible time.
It's like that feeling of like wanting to rip off a Band-Aid even though it's going to hurt more, right? You just want to get rid of that immediate pain.
Exactly.
Okay.
And that's why Bernstein emphasizes the importance of developing a long-term perspective, creating a well-defined investment plan, and sticking to it. It's about discipline, not emotion.
Okay, so having a plan is like having that roadmap, right?
Yeah.
To guide us through these inevitable market ups and downs. But, even with a plan, it's still hard sometimes to resist those psychological urges.
Right, so that's why he emphasizes the importance of rebalancing your portfolio regularly.
Okay.
What this means is bringing your investments back to your target allocation. Because over time, different asset classes perform differently. Your portfolio can drift from the original plan.
So rebalancing is about making sure that our investments, they stay aligned with like our risk tolerance and time horizon, right?
Exactly.
Gotcha.
And here's the great part about it. When you rebalance, you're forced to sell what's gone up and buy what's gone down. It's a built-in system for buying low and selling high.
So rebalancing isn't just about like staying on track. It's actually a way to like take advantage of market fluctuations. This is pretty cool.
It is.
Yeah.
And it takes a lot of the emotion out of investing, which is why Bernstein calls it making small bets with dry hands.
Okay, I love that. It's like a built-in system for overcoming our psychological biases.
Exactly.
This is all making so much more sense now, but there's one last piece that we haven't tackled yet,
Right.
and that's the financial industry itself.
Yeah.
To be honest, I'm a little intimidated by Wall Street. Any tips on how to navigate that world without getting fleeced?
Things get really interesting here. Bernstein's fourth pillar, the business of investing, is all about understanding that often murky world of financial professionals. And let's just say he doesn't sugarcoat things.
I'm all ears. Let's hear it.
Okay, well, he starts with the brokerage industry, which he argues has strayed far from its client-focused origins. He tells the story of Charles Merrill, who built his firm on the principle of putting clients' interests first. Sadly, that legacy was kind of betrayed as the industry became increasingly focused on generating commissions.
Wait, so the more we trade, the more money they make, even if those trades aren't in our best interest.
Yeah, it's a system that's designed to benefit the broker, not necessarily the investor. That's why Bernstein is such a huge advocate for understanding fees and minimizing costs.
Okay, so watch out for those hidden commissions.
Exactly.
Gotcha. What about mutual funds? Aren't those supposed to be like a safer way to invest?
Well, mutual funds can be a great tool for building a diversified portfolio, but the fees they charge can quietly eat away at your returns over time.
So it's all about being informed, not just blindly accepting, what we're told. We have to be savvy consumers of financial products, just like anything else.
Yeah, you got it.
Okay.
And, when it comes to the financial media, take everything with a grain of salt.
Mm.
Much of that is just designed to generate excitement and encourage trading activity.
This is already so eye-opening.
Yeah.
It feels like, Bernstein is giving us this roadmap to navigate the financial world, like with confidence. But what about you? What's one piece of financial advice you'd give your younger self based on what you've learned from Bernstein?
That's a great question. If I could go back in time, I'd tell my younger self to start investing early and consistently.
Right.
Even small amounts invested regularly can grow significantly over time thanks to the power of compound interest.
Compound interest, it's like magic.
It really is. Yeah.
Your returns start generating their own returns.
That's right.
But sometimes, even when we know what to do, it's hard to actually take action. What's like the best way to get started?
That's where having a plan is so important. When you have a clear roadmap, it's much easier to stay disciplined and avoid those emotional pitfalls that we talked about. Think of it like, having a budget for your money. It helps you make conscious decisions about how you're spending and saving.
Right. A budget helps us prioritize our goals, make sure we're allocating our resources effectively. But speaking of saving, how much do we actually need for retirement? That always seems like such a mystery.
Ah, the million-dollar question. Bernstein dives into the retirement numbers game in a lot of detail, and it can be a bit daunting. The key takeaway, though, is that it's not just about how much you save, but also about how much you withdraw each year.
So how do we figure out that magic withdrawal number without running out of money before we, kick the bucket?
Well, Bernstein walks through several approaches. He has one called the back-of-the-envelope method, which suggests withdrawing only the real return of your investments each year. He also points out that a bad sequence of returns, like a prolonged bear market early in retirement, can really impact your portfolio's longevity.
So even with a conservative approach, there's still an element of risk.
Absolutely.
Okay.
That's why he stresses the importance of having a margin of safety. He suggests, a slightly lower withdrawal rate than you think you'll need, account for those unexpected market downturns or life events.
So it's all about finding that balance, right, between enjoying our retirement and making sure that our money lasts.
Exactly. It's about planning for the unexpected. And speaking of planning, did we ever talk about TIPIs?
Tip yes.
Treasury inflation-protected securities. Bernstein actually suggests they can be a really valuable tool for retirees, especially in a low-interest rate environment. Their returns are adjusted for inflation, so you have a predictable income stream that keeps pace with, rising prices.
Okay, so TPS are like a safety net against inflation, which, makes sense. As we get older, we have less time to recover from, market losses.
Exactly. Now, once you've figured out your retirement number and your asset allocation, it's time to actually build that portfolio. Bernstein emphasizes selecting the right building materials, the specific mutual funds or ETFs that will make up your investment strategy.
Okay, this is where I start to feel overwhelmed because there's literally thousands of funds out there. How do we choose the ones that, align with Bernstein's philosophy?
Well, he's a huge advocate for low-cost index funds. Costs matter, especially over the long term. He points to Vanguard, the company founded by John Bogle, as a prime example.
Yeah, Vanguard, they seem to be the gold standard when it comes to index funds. Their fees are incredibly low. They have a great reputation for, putting investors first. But what about actively managed funds? Are there any situations where those might make sense?
He's generally skeptical of actively managed funds. The vast majority of them fail to outperform the market over the long term. When you factor in the fees, it's even harder to justify.
So sticking with index funds is generally the way to go.
For most investors, absolutely.
Right.
It's about harnessing the power of the market, not trying to beat it. He suggests building a core portfolio around broad market index funds, like the Vanguard Total Stock Market Index Fund
Okay.
or the Vanguard Total International Stock Index Fund.
So start with the basics, and then we can kind of branch out into other asset classes as needed. But isn't there more to it than just, picking the right funds? Don't we have to maintain the portfolio somehow?
You're exactly right. Building a portfolio is just the first step. You need to maintain it.
So it's not just a set it and forget it kind of thing.
Not quite. Bernstein really stresses the importance of rebalancing. That's essentially bringing your portfolio back to its target asset allocation.
Okay.
As different asset classes perform differently over time, your portfolio can drift away from the original plan.
So rebalancing is about making sure our investments stay aligned, right, with our risk tolerance and time horizon. It's about staying disciplined and not letting our emotions, take over.
Right. And one of the key benefits of rebalancing is that it forces you to be a contrarian investor. You're selling what's gone up and buying what's gone down.
So it's like that old saying, buy low, sell high, but that's a lot easier said than done.
Absolutely, yeah. But that's where having a well-defined plan and a long-term perspective really come in. When you're not swayed by those day-to-day fluctuations in the market, you can take advantage of the opportunities to buy when others are fearful and sell when others are greedy.
Okay, yeah, this is all starting to click. But I have to admit, I'm already feeling like I need a spreadsheet to keep track of everything.
Don't worry. There are tools and resources available to help you implement Bernstein's strategies. He even provides some specific guidance in the book on, how to actually get started and maintain your portfolio.
Okay, so we've got our plan, we've built our portfolio, we're diligently rebalancing. But what about those unexpected life events, right? What happens if we need to, access our investments before retirement?
That's where things can get a bit tricky, especially with taxable accounts. Bernstein cautions that selling investments in a taxable account can trigger capital gains taxes,
Oh, yeah.
which can take a bite out of your returns.
So if we do need to tap into our investments, it's best to do it strategically to, minimize the tax implications.
Exactly. It's all about planning ahead and understanding the tax consequences of your decisions.
This is all incredibly valuable information. I feel like I'm finally starting to understand like how to invest for the long term and not just chase the latest fad.
That's the power of Bernstein's approach.
Yeah.
He really empowers you to take control of your financial future, make informed decisions, and ultimately achieve your financial goals.
This deep dive has been like a game changer. I feel like I've gained this whole new perspective on investing, but we're not done yet. We have to explore that 2010 postscript where Bernstein reflects on the market meltdown of 2008.
Oh, yeah. That postscript is a must-read. It really shows how Bernstein's principles hold up even during the most turbulent times. It's a valuable reminder that while markets may be unpredictable, sound investment strategies can help you weather any storm.
Okay, let's dive into that postscript and see how Bernstein's insights have stood the test of time. So now we're looking back at like the 2008 meltdown through Bernstein's eyes. What were some of those key takeaways that he highlighted after that crisis?
Well, first and foremost, he reiterates that costs always matter.
Mm-hmm.
Even in a downturn, those seemingly small fees can have a big impact on your long-term returns.
So it's even more crucial to be mindful of expenses when the market is like super volatile, right? We can't afford to let fees like chip away at our already diminished returns.
Exactly. And Bernstein also emphasizes that diversification still works.
Oh, okay.
While many asset classes took a hit during the crisis, a well-diversified portfolio would have been better positioned to weather the storm.
It's like having like shock absorbers on our portfolio, right? Not all of our investments are going to go down at the same time or at the same rate. So diversification helps like cushion those losses.
That's a great analogy.
Yeah.
And another crucial point he brings up is risk tolerance. Bernstein reminds us that it's one thing to intellectually understand risk, but it's another thing to experience it firsthand.
Yeah, it's easy to be confident when the market is going up, but when you see your portfolio like drop significantly, it can be really emotionally challenging to like stay the course.
That's why it's so important to have a realistic assessment of your risk tolerance and to build a portfolio that you can actually stick with, even during those tough times.
So it's not just about like chasing returns, but also about being able to like sleep at night. It's about finding that balance between like growth and peace of mind.
Absolutely. And lastly, Bernstein reminds us to be wary of conventional wisdom, especially during times of crisis. Remember, the crowd is often wrong.
Right. It's that like herd mentality we talked about earlier, right? Everyone rushes towards the exit at the same time, and that can lead to like panic and just really irrational decisions.
Exactly. So instead of following the herd, it's crucial to have your own plan, do your own research, and just stick to your strategy.
Okay, so those are some of the timeless truths that Bernstein kind of highlights. But were there any like new truths that emerged from the 2008 crisis? Did anything surprise him?
Yes, a few things stood out. First, the incredibly low interest rates that we saw after the crisis presented a unique challenge for investors.
Right, with money market funds and treasury bills yielding next to nothing, it was hard to find like safe income producing investments.
Exactly. And Bernstein offered a really interesting perspective on this, using Pascal's wager as an analogy.
Okay.
He argued that in such uncertain times, it's better to err on the side of caution, even if it means sacrificing some potential returns.
So in other words, it's better to like miss out on a little bit of potential growth than to risk losing, a significant portion of your capital.
Precisely. And another new truth that emerged was the importance of liquidity.
Okay.
Bernstein pointed out that even the most highly rated corporate and municipal bonds became illiquid during the crisis.
So even if you had high quality investments, you might not have been able to sell them when you needed to without taking a huge loss.
That's right. And this highlights the importance of having a portion of your portfolio in truly liquid assets like treasury bills or money market funds, even though they may offer lower returns.
It's like having that like emergency fund, right? That dry powder you can access when times get tough without being forced to like sell at a loss.
Exactly. And Bernstein also addressed the rise of exchange-traded funds, or ETFs, in the postscript.
Oh yeah, ETFs have become incredibly popular in recent years. What were Bernstein's thoughts on those?
He acknowledges the advantages of ETFs, particularly their low costs and tax efficiency.
Mm-hmm.
But he also cautions investors to be mindful of trading costs. especially if they're frequently buying and selling ETFs.
So ETFs can be a valuable tool, but it's important to use them strategically, right?
Yeah.
And not get caught up in like excessive trading that can kind of eat into your returns.
Exactly. And overall, the 2010 postscript reinforces the idea that Bernstein's principles are not just for bull markets.
Right.
They're designed to help investors navigate any market environment.
This has been like such an incredible deep dive. I feel like I've gained so much knowledge about investing, not just like what to do, but why those strategies work.
It's been my pleasure to explore this with you. And remember, investing is a journey, not a destination. It's about, continuous learning, adapting, and staying disciplined.
Well said. Thank you so much for sharing your expertise with us. This has been truly, truly enlightening. And to our listeners, thank you for joining us on this deep dive into the four pillars of investing. We hope you've gained some valuable insights to help you build a solid financial foundation.
We encourage you to take what you've learned and apply it to your own unique situation. Investing doesn't have to be intimidating.
Absolutely. With the right knowledge and approach, it can be a really powerful tool for building a brighter financial future. Until next time, happy investing.
Okay, so we talked about a lot, from market efficiency to behavioral biases to the importance of diversification. It seems like Bernstein's principles are there to guide us through any kind of market condition. But I'm curious about those new truths that came out of the 2008 crisis. You mentioned low interest rates. What kind of challenges did those present? Well, with yields on safe investments like money market funds and treasury bills basically non-existent, investors faced a real dilemma. I mean, they were kind of caught between like wanting income and needing safety.
Yeah, that's tough. So how did Bernstein advise investors to kind of approach that situation?
Well, he actually invoked Pascal's wager, which is this concept from philosophy. It argues that it's sometimes better to choose the option with less potential downside, even if it means you might miss out on some upside. In investing, Bernstein suggests that, especially in times of extreme uncertainty, like after 2008, prioritizing capital preservation over chasing yield can actually be a smart strategy.
So it's about acknowledging that sometimes the best thing to do is just protect what you've got, even if it means accepting lower returns in the short term.
Exactly. It's a reminder that investing isn't always about maximizing returns. It's also about managing risk and protecting your financial well-being.
That makes sense. It's about making sure you can survive those rough periods so you can benefit when things get better.
Right. And that actually leads us to another truth that came out of the 2008 crisis, the importance of liquidity. Bernstein pointed out that even highly rated corporate and municipal bonds, which are usually seen as relatively safe, they actually became really hard to sell during the crisis.
So even if you had investments that were, fundamentally good, you might not have been able to actually get your money out when you needed it most.
Exactly. And this highlights how important it is to have a portion of your portfolio in assets that are truly liquid, like treasury bills or money market funds, even if they offer lower returns. Having that cash readily available can give you peace of mind and flexibility so you can handle those unexpected events without having to sell your long-term investments at a bad time.
It's like having a financial cushion so you can get through the tough times without making, rash decisions that could hurt your long-term goals.
Exactly. Now, Bernstein also addressed the rise of exchange-traded funds, or ETFs, in the postscript.
Oh, yeah. ETFs, they've become so popular. What were Bernstein's thoughts on those?
Well, Bernstein recognizes the benefits of ETFs, especially the low costs and tax efficiency. But he also reminds investors to be careful about trading costs, especially if they're constantly buying and selling ETFs.
So ETFs can be a really good tool, but it's important to use them strategically as part of a long-term plan. They're not some magic solution.
Right. If you're trading too much, you can lose those cost benefits, and that can hurt your returns over time.
So that buy and hold approach we talked about earlier, that's still the best for long-term success.
Exactly. Let your investments grow over time, avoid trading too much, and let the market do its thing.
This has been amazing. I feel like we've really gotten to the heart of Bernstein's four pillars of investing and learned so much about how to navigate the financial world.
It's been great sharing this with you. Remember, investing doesn't have to be scary. With the right knowledge, a good plan, and a focus on the long term, you can build a more secure financial future.
Thank you so much for taking us through this material. It's been eye-opening. And to our listeners, thank you for joining us for this deep dive. We encourage you to check out Bernstein's book and see how his ideas can work for you.
Remember, stay informed, be patient, and keep learning.
Until next time, happy investing.